Hello and welcome to Venture Best Spotlight, a podcast presented by Venture Best, the venture capital and emerging companies practice group here at Michael Best and Friedrich. We're your hosts, Evan Lonergan and Emily McGovern.
On this podcast, we will be featuring some of our amazing founder clients and network of venture capital managers, each of whom is inspiring instrumental change to the way the venture economy produces, invests, does business, and even defines a startup. Welcome to Venture Best Spotlight, a new podcast series presented by Venture Best. Here on Venture Best Spotlight, we will feature exciting and innovative guests from venture markets throughout the United States. Venture Best is the venture capital practice group at Michael Best and Friedrich, focusing on emerging companies, startup, and capital growth and exit transactions. Today's podcast is hosted by me, Emily McGovern, and Venture Best partner, Sean Stigler. Today we have Seth Levine, a legend in the Colorado startup ecosystem. Seth is a partner and co-founder at the Foundry Group, a venture capital network based in Boulder, Colorado, managing $4.3 billion in assets, including more than 320 investments and 70 exits. Seth is an author. His book, The New Builders, is a great read, and he has another book in the works. Seth is also a co-founder of Pledge 1%, a network of startup companies which encourages reinvestment in local communities by engaging in philanthropy, by contributing equity, time, product, and/or profit to local nonprofits. Pledge 1% participants have directed more than $2 billion back to communities. All right. Hi, Seth. Welcome.
Hi, Emily. I like getting when I'm introduced as a legend. What I really think is that I'm just old. Like I've just been around for a while. So the legend is just one of age and I guess somewhat of endurance as well. But thank you.
Well, it takes time to build up that reputation, right?
I guess so. No, I appreciate it. I have been. I'm sure we'll talk about it, but I've been around the venture ecosystem in Colorado for 22 years now. It's crazy that it's been that long.
Yeah, and that's our first question. Can you tell us a little bit about how you became involved in venture and how your path kind of led from start to where you are now?
Yeah, well, my entire career has been an accident. Essentially, like totally unplanned, which is, I guess people give advice that worked for them. So I'm a data point of one, but oftentimes younger people will ask me like, what's your advice for your career? And I'm always like, the less you plan it, which is to say the more you're open to interesting twists and turns, the better off it is. I'm curious if you guys have had similar experiences, but I came to Colorado in 1996. I'd spent all my summers here growing up. My dad's from Colorado. He graduated from George Washington High School. My grandmother actually graduated from South High School down in Denver. So I've got long family ties in Denver. And I spent all my summers out here. And in 96, I had been working in New York, and I decided I wanted to come to Colorado. So I was able to get a job at a telecom company way back in the day. And anyway, long story short, to get into venture, I was going to leave after another stint at a different telecoms company. It was basically early 2001, and I was going to leave my job, and I wanted to start doing some networking. And so I thought, I had a bunch of friends. I'd been a banker in New York. I had a bunch of friends that had been in venture. And so I thought, well, that seems kind of cool, right? Now, it seemed really cool because they were in venture like 1998 through 2000, but I didn't understand quite that at the time. And so I networked into a bunch of VC firms. And Stig, you'll appreciate knowing there was actually a lawyer, Mike Platt, who introduced me to Brad Feld, who now is my partner. And Brad had this great meeting with Brad where he was like super busy. He was like on his computer the whole time. And he met with me, I guess, because Platt said, please meet with this guy, Seth. And it turned out that this was SoftBank Venture Capital that they were hiring at the time. And so I ended up in that process and eventually was hired as an associate, which for me at the time was kind of a big step back. I'd been running a couple of divisions of this company that I was working for, where I helped it go public, and I had a big kind of P&L. I was managing about a $50 million business, 100 people reporting to me. But I had sold it off in pieces, which was kind of my job, which is how I kind of worked myself out of that company. They had made me an offer to stay, but I didn't really like the vision for the business. So anyway, I became an associate for Brad in 2001. It's sort of an auspicious start because my first day was like September. I don't know if it was like 5th or 3rd or 7th, but it was like very close to September 11th. And of course, that all happened. And we knew that I joke that, I didn't just show up at the party when the keg was dry. Like the keg was dry, the cops had come and gone, and everyone was like either passed out on the floor or had gone home. And then I show up and I'm like, hey, everybody, I'm here.
I'm the new guy.
Yeah, I'm the new guy. Isn't this going to be fun? And then obviously September 11th really accelerated what had already been kind of a downturn. And I spent the first 2-3 years of my venture career doing mostly workout work, which is kind of why I think I was hired, because I had a sort of a management background and I had done some workout stuff. But that was kind of the start of the venture career. And at the time, I signed up to be an associate for Brad for 2 years. That turned into 3 years. That turned into 4 years. I got promoted to be this super junior partner at SoftBank, which had changed its name at that point to Mobius. And then in 2000 and maybe late 2005, early 2006, I sat down with Brad. Mobius was raising another fund, and I said, "Hey, Brad, I'm not quitting today, but I just want you to know I'm not going to stay. I'm not interested in being a super junior partner at this, the new fund that's being raised. It wasn't going to work for me. By then we had our first kid. I was just, I was thinking about what I was going to do with my life. And it was one of those fateful conversations where, Brad said, hey, it's actually not going so well. The fundraising, I don't think we're going to do anything. I was thinking about maybe kind of branching off and doing what we do here, but, starting a new firm. What do you think about doing that with me? And that's what kind of started the conversation that led to Foundry. Ultimately, we invited Jason and Ryan, our two other founding partners, out from California. They moved out kind of in mid 2006. We raised our first fund in 2007. So I tell the details there just because I did want to at least back up what I said about there's a certain amount of randomness in my career. And when I started in venture, I certainly didn't think it would be a 23-year plus run. And then when we started Foundry, I didn't have any idea it would become the platform that it did, right? We tried to raise our first fund. It was going to be $175 million. It almost didn't come together. There was a point in the middle of that where I truly, not only did I not think it was going to work, I remember going home and saying to my wife, I don't think this is going to work. And raising a fund was expensive. We had put up our life savings to do it. And I was apologizing. I lost the life savings. And worse, I got to go find a real job because I've been in venture for 5 or 6 years. I didn't know what I was going to go do. So it's not always a straight line, I guess. And it ended up working out pretty well. But I think being open to that randomness, I think really served me well.
Well, and just, no, thanks so much for sharing. And I think so few people know the Mobius SoftBank Genesis side of things too. But if you don't mind, because I think I just got back from Raleigh, North Carolina, which is a great market that's really coming into its own, and we'll get into the new builders side of things too. But I think a lot of folks think Austin, Boulder, some of these other markets have just always been big VC startup markets, but it really wasn't in 02, 03, 04. It was starting to, but what was that like? Between you and Techstars and, Rocket Ventures, it was really you guys created this ecosystem. Brad Bernthal, the universities and others helped and had a play, but what was it like to just, it was not known as a VC hotbed / entrepreneurial hotbed in 2003.
Yeah,
2004.
Absolutely.
Yeah.
I think people experience something and then they assume it's always been like it is now. And
right.
The truth is Boulder was very much not like that. And by the way, Denver was very separate from Boulder, right? It was a totally different market. And it was sort of like the telecom market, right? There was a lot of Denver sits on a line in the US where you can bounce from one satellite and you can be in Asia, or one satellite and be in Europe. And so there were all these old teleports. And then because of that, there were all these competitive local exchange carriers, but alternative phone companies that were based out of here. And that was very much a khakis and blue shirts sort of world. And it's sandals and t-shirts. But the venture scene was very nascent, and people just didn't believe that $1 billion outcomes could be generated in Boulder. And so, Brad was out here. Obviously, there were some other venture firms, Sequel Partners was out here. Boulder Ventures already existed at that point. Yep. Kyle actually was very generous. Who's the guy that founded Boulder Ventures, was very generous to spend some time with me as I was networking back in 2001. So there were a few other firms here, but it wasn't a truly established ecosystem. And I think people kind of take it for granted that it sort of always has been that way. But the truth is, and really the deep dive on this was the book that Brad wrote called
Sure.
Startup Communities, excuse me. And he talks about the Boulder thesis, and he describes the history of Boulder even way before. There were some other venture firms that were around even before the ones I just mentioned. But he talks a lot about how it was really a collective, right? I mean, you mentioned a couple of people, Brad Bernthal, obviously David Cohen from Techstars, but it was also people like Robert Reich, who did, Ignite and Boulder Startup Week,
UTech Meetup.
Yeah, exactly. And Andrew Hyde, who invented Startup Weekend and Startup Week. Like, there were a bunch of people, and we were among those people, but by no means were the sort of leaders of that, right? It really was this incredibly organic experience. And then what happened is there were some really great businesses that were built here. We had some IPOs, we had some billion-dollar exits, and then I think that's kind of what put Boulder on the map. And then in the meantime, Denver also became its own sort of technology startup sort of hotbed, and the two markets kind of blended a little bit in a way that I thought was great, right? I mean, it's kind of nice to feel like they're completely separate, and they really were, as recently as probably 10 years ago. So so the markets, I mean, it's been really fun to watch the market evolve, and obviously I feel an incredible amount of pride in having had not played a huge role, but played a meaningful role, I think, in helping do that. But I was just at Denver Startup Week, from when we're recording this, it was like a couple weeks ago. It's the largest startup week in North America. And so cool. I think what Ben and Tammy and Eric have done there is just remarkable. And it was really fun to spend time there and just kind of, I mean, I participated in a bunch, but I also just observed a lot, and just seeing what it's all evolved to is really amazing.
No, so cool. And it is so, we used to joke when like our office was in Boulder that it was like people felt like you needed a passport to get between the two towns when they're 15 miles apart. It's like, and I feel like it really has blurred a lot more. A lot of folks have, employees in both places or working back and forth. So yeah, it is so cool. Well, Emily,
and by the way, the pandemic really also changed the landscape because it turned out a lot of people moved here to work remotely from here, right? Here meaning really anywhere in the Front Range. And I think that's actually been it's been a great dynamic, right? I mean, just again, recently, I mean, Klaviyo, it's a B2B, marketing software business, just went public a couple of weeks ago. One of the founders lives here in Boulder, right? Now newly minted, I think, billionaire, or pretty close to it, actually, at least on paper. And so awesome. That stuff's great for our ecosystem.
No, absolutely. I was just Emily, I know you have more questions, so I'll shut up after this, but I know you're an investor and longtime supporter of Greater Colorado Venture Fund, which is another way you've given back and supported sort of underrepresented founders. And they had their big conference in Salida, and just seeing, again, the pandemic has changed the workforce, and given all the natural beauty and mountain towns and awesome opportunities, seeing all the talent that's come to places like Telluride, Salida, Aspen, Durango, Grand Junction, it's so cool. So,
well, Seth, to follow up on your mention of the role that Foundry Group had in building the kind of Boulder startup ecosystem into what it is today, understanding that every startup ecosystem is different and has its own players and components and specialties, what would you say, as much as you can speak generally, the role of a venture capital firm would be in kind of evolving startup ecosystems like Boulder, but also like Kansas City, St. Louis, Des Moines, even Madison, that are, always growing and always evolving?
Absolutely. I mean, look, I think what's interesting, and for me, kind of most exciting about the change in venture that's happened in the last 20 something years that I've been in venture, really, it's two things that I think are most interesting and most promising. One is that when I got into venture, there was an adage that you really needed to be in. If you wanted to be an investor in venture, you should only be in the top like 5 or 6 names. And there was some truth to the idea that there were concentrated returns across a relatively small number of firms, but the asset class itself actually was not one that typically outpaced the market. And that's changed a lot, right? There are a lot of, I mean, when we started raising our fund in 2007, there wasn't really a category of emerging managers as we describe it today. And it was really hard. It's one of the reasons we almost failed in raising it, because people just didn't believe in the idea that there were returns to be gained from a new fund. Obviously, there have been a bunch of funds since then that have proved that completely wrong, which is awesome. One of them was Foundry. So that's thing one. And then thing two is this idea that really venture existed primarily in Silicon Valley and maybe a little bit in Boston. And that truly was how people thought about it. I actually, when I was early in my career as a partner, so 2007 to 2010 or 11 or so, I spent a lot of time in New York City because I had good networks there. I did some early ad tech deals that were successful, and that tended to be a hub for ad tech. And I mean, I say that today, and people are like, "Well, yeah, of course, New York, like, you know, that's a huge venture market." It was not at the time, and the reason that I spent so much time there was because, as a newly minted partner, I needed to find some place I could go where, you know, there weren't a lot of other people running around, and New York was that place, right? I mean, Union Square existed, First Mark existed, and Josh Koppelman was a little south of the city in Pennsylvania, and he was doing some deals in New York, but like that was kind of it, right? Excel didn't have an office there. I mean, you know, Spark didn't have an office there. There were all of the firms you think of now as these big New York firms didn't exist, period, or didn't have an office in New York. And so that's a huge change in venture, right? So, and it's not just big cities like New York, or for that matter, Southern California and LA and that whole area, but it's also the Madisons of the world and Kansas City and Minneapolis and other places that really are now on the map as meaningful startup communities that weren't as recently as like 15 or 20 years ago. And I think those really are the two big changes in the venture landscape since I got involved. And if I could plug for it, hopefully the next big change, and we're sort of on the cusp of this, will be a meaningful diversification, I think, first of check writers, and then ultimately of businesses that are taking money from venture. We still, if you look at the statistics, we have a long ways to go. Yeah. But when I think of even just our own portfolio, and we just had all of our CEOs together for our CEO summit, significantly more diverse than it used to be. And in particular, when I think about our partner funds, so when we invest in other venture funds, we have about 46 funds. Those are also significantly more diverse. So I think that's the next thing that happens in venture is that, and hopefully there's some staying power there. We've had a few fits and starts of this, but there'll be fewer people that look like me and more people that look like you.
Emily, forgive me, I'm going to interject here just because I can't help myself. But so, and thank God we are seeing it in some of the big, like, we're fortunate to work with some big sort of corporate investment funds that have really deployed serious capital and to foster underrepresented founders, like, and so that's good. But this is the first time in a decade where we have 5%, treasury rates, and we're having this first time we've had in a long time a pretty different fundraising and deployment market, I guess, for lack of a better term. And obviously the SVB situation earlier in the year and all that fallout. So I was just curious, like, what are your thoughts? Because on the one hand, if you look at the statistics, especially with your seeding of great emerging funds and emerging managers and what you guys do, by a lot of measures, now is the best time to invest in early stage companies from a cyclical standpoint, but it can also be a tough fundraising and frankly, fundraising both for funds and for founders right now. What are your thoughts on the market?
Yeah, I mean, look, long-term high sustained interest rates, I mean, there's part of that is good, depending on what you're doing in the market, but there's a lot of systemic challenges that arise from that, not the least of which is, by the way, cost of borrowing, and of course, all of that stuff is really important. But and on exit, right, because PE firms have become big acquirers of technology businesses, that becomes significantly harder when you're borrowing money at 8, 9, 10% versus 3, 4%. And so, but the other issue is that it becomes much harder to raise capital because there are safer places to put money. I just had an email from a guy that I know is a trustee, sort of an asset allocator, and essentially he was saying, hey, there's a chance to lock in 5% interest rate, for zero risk right now. Like, I'm moving a lot of my portfolio to that. is the risk really worth it? And I think people are going to have to naturally ask that question: is the risk in other asset classes? This is not just venture. Other asset classes. So I think that's a challenge. Now that's balanced by the fact that you're absolutely right, Sean. Like we know that downturns are the time to invest, and there are great companies that get started in downturns for lots of different reasons, not the least of which is there tends to be a little less competition for capital, for labor, for marketing dollars, things like that. And that really helps startups, especially in the early stages of their business. So, unfortunately, the market often gets it a little bit backwards. And we just raised for our last fund, and we were in the market kind of before the market hit its peak and then came back down. And we were a very deliberate investor. So when we raised in 2018, we said we were going to invest over 4 years. And despite the fact that there was a lot of pressure to put money out quickly, we decided to invest methodically and invested over 4 years. But at the time, in sort of early 21, when we were raising this last fund, really mid 21, we did hear from a lot of potential investors, hey, even existing investors, why didn't you invest faster? There's never been a better market to invest. And we were trying to describe, no, there's never been a better market to raise follow-on capital. What matters is entry price and exit price. And we don't love the entry price right now. So we're going to be a little bit more cautious. And we took some flack for that, actually, which I'm glad we kind of stood our ground. And ultimately, I'm really proud of the portfolio we built, but also that we kind of stuck to our knitting. But I do worry about sort of there is a bit of a collision of the diversification of venture managers with, and that happened to coincide with a market that was really hot. And so I worry that 2020 is going to be a bad vintage, right? I mean, we have these in venture where and this is why as an investor in venture, you want to diversify what vintages you enter in. But 2020 could just be a bad vintage, right? And I worry that might have some secondary and tertiary effects on people that are first-time fund managers. Whose first funds happen to be in this bad vintage. So I hope not, right? I hope people can see through that. But I think about that a lot.
Yeah.
And for some context for our listeners, Sean mentioned the Foundry Group's method of kind of seeding with emerging managers. I know when the Foundry Group started, it had kind of a different model of investment, and it pivoted as startups do, right? Following the narrative there, to kind of from a direct investment to its current model of seeding emerging managers and funds. Could you explain a little bit about that change, what drove the Foundry Group to make that change, and kind of what the ethos of Foundry Group is now?
Yeah, and I would describe it, Emily, as more of an expansion than a pivot, because we kept our existing business and then we added this funds business. But so Foundry started as a very traditional seed, mostly Series A investment firm in 2007. And then in, 2012, 2013, we added sort of a later stage investment vehicle, basically investing in later stages in the existing portfolio. And all along the way, my partners and I had been investing our own personal money into various venture funds. It was an interesting way to get, you get quarterly reports, you get looked through into all these different companies. And it was an interesting way to just sort of get a view of the market. And obviously we thought we'd make money doing it. But sometime around 2015, we started talking about the idea of professionalizing that. There, for whatever reason, GPs, which are what you call the people that run venture firms, had not traditionally also been LPs from an institutional perspective. LPs meaning investors in funds themselves. And we thought, well, this could be kind of interesting, right? Who would be better suited to be able to evaluate emerging managers in particular than people that were also venture fund managers? And so we decided to professionalize, institutionalize what we've been doing just on our own on the side. It would also help us write bigger checks. We go back and forth on what the right model is for Foundry, but it's certainly I'm not going to keep doing this for a long period of time. And one way of seeding generational change, not at Foundry and trying to own it, but doing it more broadly, was to invest in lots of other firms and try to add a little bit of advice and our own flavor for venture sort of through those relationships rather than trying to build our firm up. which was the more traditional way to do it. So all of those things led us to decide that we wanted to create this fund of funds practice. We ended up inviting a guy who was our biggest investor. He ran the emerging manager practice at the University of Texas investment management company, UTIMCO. And he joined us in 2016, late 2015, and then we raised this our first fund to professionally invest in other venture funds in 2016. And so we've got a couple funds that do that, and we have, I think it's 48 managers that we've invested in now in the underlying portfolio, and the look through is crazy. I mean, we probably have 4,000 companies that we look into through all of those funds, and we got a lot of data on those companies, which is interesting. Obviously, we get great data on the market, and then of course we think it's a good way to also boost our returns.
Yeah, it's so fascinating, right? Like the private markets, the venture markets, the PE markets are all about like data asymmetry. But if you did the same thing in the public markets, it's very frowned upon,
illegal,
right? So, but it's why we have the best engine in the world to still grow innovation. So
absolutely, and I mean, look, it is part of what makes America kind of the best startup market in the world, right? And not that there aren't other interesting countries to invest in, but the truth is America has sort of long had a history of being particularly innovative. And I think that dates back to and that relies on all sorts of things, from our early embracement of failure and bankruptcy and things like that, to sort of the open innovation economy, to relatively free-flowing capital, to relative, I still think there may be too many regs on it, but relatively unregulated private capital markets, things like that.
Yeah. No, awesome.
I think that's a good segue into your book, The New Builders. There's a lot of good history and thought comparison on, the evolution of economic theory and how we've.
Oh, you've offended him, Emily. He's leaving.
I realized I should just have it on my desk so I can hold it up, but that's what it looks like.
For our listeners and viewers, you can buy this on Amazon. There's the cover.
Absolutely.
But you have
or
a lot of
cover if you're listening locally, or any number of other great local bookstores. But Amazon's the easy way too.
Yeah, well, going off of your previous statement, you have a lot of interesting insight into economic theory and how it's evolved over time, especially with regard to entrepreneurship and our, recent fascination with and the evolution since, I guess, the 90s and early 2000s of this concept or myth, I guess, of the startup founder. Do you want to kind of summarize your?
Yeah, I'll jump in, and now's where you're really going to have to interrupt me, because when I get going on The New Builders, I talk for hours and hours, because it really was a passion project for Elizabeth and for me, my co-author and me. And it was not the book that we thought we were going to write. We thought we were going to tell. Elizabeth and I met over, actually, interestingly, a shared interest in Palestinian entrepreneurship, which is probably a totally different story.
Wow.
But we then started trading stories of just interesting entrepreneurs that we met around the country that weren't really being covered in mainstream press, particularly women and people of color. This was, maybe 4 or 5 years ago, as we started trading these stories. And we thought we would write this sort of lighthearted book, almost like a coffee table book, to highlight some interesting stories of non-traditional founders. It's going to be called Faces of Entrepreneurship. Actually, it's my folder on my Google Drive where we started all the book stuff is still called Faces of Entrepreneurship.
That's awesome.
But as we unpacked it, we realized there was a much more important story to be told here, and I think we understood that there were some challenges around access to capital and some structural things that were going on in the broader entrepreneurial landscape. But I think we didn't realize how challenged things were. And so there are a couple key themes that are worth just sort of laying out, and then really people listening should just go buy the book and dig into it. But the first is that entrepreneurship is much broader than we typically talk about in the sort of venture world, right? We talk about venture eating entrepreneurship in a way that's really pernicious. And, as we talk to people around the country, we think about entrepreneurship incredibly broadly, and yet we've come to define entrepreneurship as meaning tech entrepreneur. We talk about the history of that in the book, because it's really fascinating the way it kind of started with Reagan, and he was using it to combat communism, and capitalism was sort of the anecdote. And he, of course, he knew Silicon Valley quite well because he'd been the governor California. We dig into it much more in the book, but there's an interesting history about it. But we really have narrowed the definition in a way that we think is detrimental to entrepreneurs writ large. And just interestingly, a statistic that sometimes people don't understand is only about 1% of businesses in the US get funding from venture capital. They're important businesses. They power lots of things that we do. They obviously are a catalyst for small business as well, but it's 1% of businesses take money from venture. And by the way, only about 17% of businesses take money from banks, right? So the vast majority of people that are starting businesses, think about, the kind of business that you might see if you walk up and down Main Street in whatever town you live in. Those people are kind of figuring it out on their own. And as a result of that, there's actually been a bit of a decline in entrepreneurship. Now, over the last couple of years, I think this relates to COVID, there's been a huge spike in new business licenses. So I'm hopeful. We talk about the history and some of the decline, but I'm quite hopeful that in the last few years we've maybe reversed that trend. But the other thing that we really talk about and dig into deeply in the book is that the people that are starting businesses today are very different than the people that started businesses 50 years ago. Specifically, women and people of color, immigrants, as they kind of always have, start businesses at much higher rates than white males. In fact, white men are the minority of business owners in the US right now. Women start businesses at 4 times the rate of men, and Black women are the single fastest growing group of entrepreneurs. But we're forcing these new builders to rely on essentially their own resources. And, after 400 plus years of systemic racism, et cetera, the average Black family has 1/10 the wealth of the average white family. The average Hispanic family has 1/7 the wealth of the average white family. These ratios, although they're not quite as stark, but they still hold up, even when you control for education of head of household or income of head of household. This is a wealth gap, not an income gap. And I think that's the thing that people sometimes fail to understand. And because of that, we're just making it really hard for people to start businesses because there aren't places for them to turn to, right? 80+% of businesses in the US are effectively bootstrapped, right? People fund them with credit cards. They fund them with friends and family money. They fund it with money from a home equity loan. And that's just simply not as available to the people that are actually starting businesses these days. So that's kind of what we talk about in the book, and it's a bit of a call to action for people to think about how to address these issues. There is a chapter that has some pragmatic advice. Hopefully that'll hold up over time. But the rest of the book is super timeless, right? I mean, it really is. It's interesting because we continue to do events and have people reach out about the book. Even though we published it a couple of years ago, it remains incredibly topical. And I think I think that's a testament to the staying power of new builders. This is the face of entrepreneurship. But I think it's also just because this issue remains challenging in our society and we haven't figured it out.
Yeah, incredibly topical and incredibly important that conversation keep happening.
Yeah, I was going to say, Seth, I know a lot of the book is evergreen. Well, theoretically, all of it is, but I mean, a lot of the folks listening to this in our community is in a position to be of service and to contribute to this effort. And so if you don't mind, I mean, if you were to give a top, 1, 2, 3 ideas for those of us who maybe have talents or resources or are in this more narrow ecosystem that could help the broader ecosystem, any thoughts come to mind?
Yeah, absolutely. I mean, it's funny. I was thinking about this and talking about it with the Denver Startup Week founders as an example, right? Like when we do things that are entrepreneurship related, we should think about that very broadly, right? I did an opening, the kind of kickoff thing for DSW this couple weeks ago. And that was kind of the theme of what I was talking about is that, DSW is an event for all entrepreneurs, not just tech entrepreneurs. And acknowledging that, I think, is critically important. The other thing I say to folks is I spent years, we spent time researching the book and then writing it and then promoting it. I spent a lot of time, for the first time in my life, in rooms where I was the minority all the time. And I learned a lot through that, right? And I think that we live in a world where we are afforded incredible comforts, right? It's very easy to stay in our bubble and to always be participating in arenas where we're sort of the masters, if you will. And I think that I would challenge people on that, right? I mean, I think one of the things that I learned the most, and frankly, the advice I give the most, is get out of your comfort zone and find yourself in places where you really have extended your network, right? And you feel a little bit uncomfortable, because that means you're actually trying to do something. And you have to be comfortable with the idea that maybe you'll say the wrong thing, or maybe you won't understand something, or maybe you have to ask people questions that sort of show your ignorance. I don't mean that in a positive sense, but I think that is challenging. And put yourself in a position to maybe leverage your network, right? And sort of what you have built up over the years for the benefit of other people, right? I think one of the best things that people who have built up established networks and are very much sort of part of that mainstream can do is to be generous with that network and their time, and really help people that are still trying to build those networks, while recognizing that it's really hard in many cases to be that person who doesn't look like everyone else in a room. And if you're an entrepreneur of color, and in many cases if you're a woman as well, almost every room you walk into, you are the minority, right? And I think having that experience a few times yourself is humbling. And I hope will make people think differently about how they leverage their own networks for the benefit of others. Obviously, then go look for opportunities to invest in people that are struggling to find investment. And I mean, I have really loved looking at opportunities to invest in kind of more Main Street businesses, right? Because I think that's a way to really promote community. And one of the things we talk about in the book is that the new builders are really the fabric of our communities. And
for sure.
I know my wife, but she's doing a bunch of development work in Longmont, which is the town where we live.
So cool.
In downtown. And a lot of that is driven by her desire to create buildings that are accessible for business owners that look like new builders, right? That are working on interesting ideas and that will kind of add to the vibrancy of Main Street. And she's a for-profit developer, right? She's doing this to make money, but she also recognizes that making money is a long-term proposition, not about what cap rate you get tomorrow and getting a bank or someone that's not necessarily going to enhance the community fabric into a building just because they can pay a little bit more, but instead really being deliberate about what goes into each building. So I mean, that's just an example of it. I'm proud of it.
No, it's such a great project.
Talking about it, but
it's
a great example of she could have gone a completely different direction and just decided that she wanted to maximize every dollar, but instead she's trying to figure out how to create community, and by doing that, create more long-term value.
So in that vein of how people who are in a position to build the startup ecosystems that we operate in to be more diverse, to be more reflective of our communities at large, how do you see venture capital firms and service providers like law firms taking steps to be a positive force in our ecosystems and to remedy that disparity as much as we can in the near to far future?
Yeah, it's so challenging, right? Because it's just easy to kind of keep doing what you're doing, and so I think there is a bunch of things that need to happen to help diversify the venture side. Again, it's 1%, but it's a lot of money, so it's really important to diversify the venture side of things, right? Which starts with being more active recruiters of and networkers for diversity in our spaces, right? Again, thinking back to Denver Startup Week and how do we lean into making sure that we create spaces that are inclusive of people from other perspectives and other backgrounds, critically important, right? And then, when I hear from other VCs, the most common thing I hear about why they don't invest in more women and people of color is that they lack the pipeline, right? There just aren't as many women and people of color starting businesses. And I always push back and say, that sounds like a network problem, not a pipeline problem, right? So pipeline is to blame it on other people. Network is, hey, it's your problem. But you have to be super deliberate about it, right? We struggle with this at Foundry. Our jobs are to make more money for our investors. I would like to figure out a way to do that by investing in more diverse managers and companies. And we've been very successful in diversifying the managers we invest in. We've not yet been as successful in diversifying the companies, the founders that we've invested in. Some of that's just a natural lag. The funds we invest in are seed funds, and we invest in Series A and Series B. So hopefully, as some of the underlying companies in those funds that tend to be a bit more diverse because of the managers that we've chosen to back, as those companies come up for their Series A, Series B, hopefully that'll naturally happen. But I think we need to keep our eye on it and make sure that we're being thoughtful about how we do that. Because it's really easy just to take the next thing that comes across your desk and say, great, the next thing that I like, I'll do, and not think about sort of what kind of portfolio you're putting together. The other thing I'd say is that I think that there's a little bit of the right word for this, but there's sort of a challenge that venture has, which is like when we look to founders of color or women, we look for them to start businesses that relate to their community. Right. And we don't have that double standard for guys. And so I think we need to question that a little bit. Right. I think that there are plenty of well-meaning VCs that are running around looking for, a Black female founder that's working on some product that relates to people of color. And instead of just looking for a Black female founder who happens to be an expert in marketing SaaS or whatever it might be. And I think there's a bit of a double standard there that we need to kind of get away from, because I think there is this tendency to see women and people of color as sort of starting businesses that relate to their background as a woman or as a person of color, and not based on their background as a product manager at Google or wherever they came from. And I think that's really a really important thing for people to get in their heads and think about. Also, the new book to talk about, which I'm really excited about. I got another year. We're just starting to write it right now, but we've conducted over 50 interviews. We talked to people like Jamie Dimon and Dick Parsons, and Dan Schulman, a bunch of other interesting people.
Well, tell us about that.
And the book is about the evolution of capitalism, right? So we've lived for all of our business lives, we've lived with this idea that shareholder primacy is the only thing that matters for companies, right? Milton Friedman famously outlined that in an essay in the New York Times in 1970. But the truth is that's not really how capitalism has been defined over sort of periods of generations before that, right? And in fact, really, Friedman started the end of what was known as the golden age of capitalism, which was an era of incredible growth and prosperity that came after World War II. Kind of ended in the mid to late 70s, right? I mean, really ended with Reagan being elected president, and that some of the policies that he and Margaret Thatcher pursued that really were kind of based on the Friedman Doctrine. And so we're exploring this idea that, maybe there's an opportunity to move back to something more like the golden age, right? In 2019, the Business Roundtable, led by Jamie Dimon at the time, declared that actually businesses had constituencies that they needed to think about beyond just shareholders, right? Employees, other stakeholders, the environment, things like that. But at the same time, companies are facing incredible pressure to take stands on all sorts of social issues. I think that is reflective of the sort of degradation of the media and of government, right? In terms of how people don't rely on or believe in those institutions anymore. They don't believe that they're reliable. And so they're looking to corporations to fill those voids. And part of the thesis of the book is we're asking too much of these companies. So yes, stakeholder capitalism should have a moment, right? Because we might think of it as long-term shareholder capitalism. But I also think there's some areas where we should agree on some trade-offs. But we also need to be careful that we're not expecting too much of companies, right? That every issue that pops up, they need to take a stand on. And we've become sort of increasingly polarized. And when you hear people talk about woke and anti-woke, that's a sign that there's a debate going on. Those terms are politicized terms that exist to try to divide people. And we're trying to write about sort of where companies meet in the middle, and this idea that you can run a values-driven organization that's not necessarily overtly political. So there's a lot in there. It's going to be a really interesting book.
It's about a year out, you think, Seth?
That's my guess. I mean, we just started writing it. We got a couple chapters in. So, my guess is it's probably 9 months to get it all written and then a few months to get it, edited and published.
Yeah. Well, and it has been, I mean, certain CEOs have caught a lot of flack for saying this is where you come to work, even though those organizations have also done very intentional things about hiring practices or philanthropy or whatnot. But, and then you have the whole regulatory capture. I don't know if you touch on that in the book too, but that's interesting too, of like, it's such an interesting, it's a perfect time for this book.
And you hire a trans spokesman, and then you get, pillarized by the group that's kind of your main constituency, right? Or you're Disney and you come out against the Florida bill and you go through that whole rigmarole. I mean, it just, you're Chick-fil-A, which is a relatively conservative, like religious-based organization, private company in that case.
Yeah.
And they have a head of DEI in their organization, and they got called out on the mat from their constituency for that. Like, you can't win, right? And that's kind of what we describe as like, there's pressure from both sides, and there's probably unreasonable pressure from the farther reaches of both sides, which is kind of what we describe in the book.
Perfect time. Perfect time for this book. Yeah.
What's that? How do I have time for that?
No, it's perfect time for this book. I mean, it's such an important issue.
Yeah, no, it feels very, very timely. Everyone I talk to about it or share the treatment with. So I just need to carve out more time in my, the problem is I have a couple of jobs, so it's hard to always have so much time to write. And as you know, to write thoughtfully, you need like a 3-hour chunk of time, right?
The writing process.
When I wrote The New Builders, the pandemic had just started. So I was able to carve out all this time because I wasn't traveling. Right now I'm used to the new normal, which is, we've kind of filled up all that time. And so, I'm desperately trying in my calendar to hold on to blocks of time to do some writing, but hopefully it'll be relatively quick. And certainly as soon as I get into writing, this is such an interesting topic. Words kind of flow off the fingers as we do that. But it's still, to write a book of the type we're writing, we're talking about probably 120,000 words before we edit it down. So, that's quite a bit of time.
Yeah. Well, so excited for that one. Yeah. Looking forward to it.
Awesome. Thank you.
We'll have a Venture Best book club. We'll all read it.
There you go. Love that idea.
All right. So I guess for our last question, we can go back to The New Builders. In The New Builders, you discuss redefining our collective concept of entrepreneurship to better represent a more diverse class of founders and startups. How would you define entrepreneurship?
So one of the most interesting things that we discovered when we were writing The New Builders was that so many of the people that we interviewed did not define themselves as entrepreneurs. And they would say, no, I own a cake shop, or I'm a franchisee of yogurt businesses. Like, they didn't think of themselves as entrepreneurs. And that's why we really we wrote this book for New Builders, like to take back this sort of entrepreneur idea to be inclusive, to mean all people that are doing interesting things on their own to change the world, to start a business, to grow their business, et cetera. And I think that was kind of my key takeaway, is that we've really stolen something from all of these incredible people that are striving to do better for their families, their communities, and themselves, by taking this word entrepreneur and sort of narrowing it down to mean only tech entrepreneur. And so I hope that people sort of see things differently. One of my favorite things to do, and I didn't really think about this as much before I wrote the book, but especially when I'm in a new place and I'm just in a shop, is to talk to the person behind the counter, right? Because oftentimes that's actually the business owner, right? And so you can really, and I ask them, hey, how long have you owned this business? And like, what's working, what's not working, and what do you see here? I have found those to be so rewarding and so interesting, and it's forced me to see things through a different lens as I walk down a street in a town, right, and kind of look around. I realize how much goes into each of these businesses, that lines our main streets, or that it exists in a strip mall, or wherever it might be, and that there's a story behind each one that's worth telling and worth understanding. And I think to me, that's the essence of entrepreneurship, is understanding that the striving, the perseverance, the risks that it took for people to pursue what is in many cases their dream, right? The business that they always wanted to own.
That's awesome.
Yeah, I think that's a good definition for us all to take to heart as we continue to serve, hopefully, more than just the narrow definition of founder into the broader definition of entrepreneur.
Absolutely. Well, I know Michael Best does that incredibly well, right? I mean, Stig, I know many of your clients have always been, I mean, some on the tech side, but many clients have been, local businesses, right? And I think that's fantastic.
Thank you for listening to this episode of Venture Best Spotlight.
Please make sure to subscribe for our upcoming episodes featuring our network of amazing innovators.